another iteration of the quarterly market insights webinar here at Zenith. I'm joined here with my teammate Andrew Tudor. We're excited to get into it this quarter. You all know us hopefully by this point, but if you don't, my name is Jason Ray. I'm the Chief Investment Officer here at Zenith, and I'll give it over to Andrew to introduce himself.
Perfect. I'm Andrew Tudor, investment advisor here. Work primarily with our institutions around mission line investing and making sure that we are achieving the returns in the portfolios to fuel the missions. So excited to talk about markets. We've had a really good few months of performance, and outlooks going forward looks pretty good. So yeah, let's get into it.
Perfect. So per usual, if you have any questions or thoughts, please come in the chat. Feel free to come off mute. This can be as interactive as we want. We also have some questions that were submitted in advance, so we will address those as relevant. Our objective here today is to really deliver actionable insights relating to macroeconomic trends and investment industry information. So today we're going to talk about a few key themes, market takeaways, some themes to watch, and what to expect looking ahead. So with that, Andrew, you want to dive into what happened over the last quarter?
Absolutely. So we are coming to you after a very productive and performative Q3. What we saw, number one, with global equities posted really strong gains. So the S&P 500, which is the 500 largest companies in America, in the quarter posted 5.4% rate of return, which if we multiply that out, annualized, that's over 20%. That is very, very good. There are years that we haven't done 5.4%. So we feel really confident around where things have gone in the past. Secondly, global markets have also rebounded. The European index and European and Far East, so it goes EAFE, they returned 8.2% for the quarter for Q3. So foreign and domestic strong equity returns as we come out of what was a scary, somewhat spooky, inflationary, recessionary threat. So that was equities. Also bonds did well, specifically around long-term bonds. So as interest rates drop, bonds typically do well. And what we saw were really good bond returns inside of client portfolios and across the board. And then last but not least, we talked about inflation pressures ease slightly. You know, inflation is a killer of economic growth. And what we saw were world banks, specifically the Fed in the United States, but across the board, really trying to stick that soft landing that we hear about, where they lower interest rates at the right time while keeping economic data in line. And we saw that. And so inflation's coming down across the board, and investors and businesses are responding by pumping money into the market.
And, you know, I feel like it's been the same thing for my entire career. We've seen such strong returns. Can this continue? The S&P 500 is really facing some stretch valuations. It's trading at a forward price to earnings ratio of about 19 times. Historical average is 16 times, which just means that the equity markets are expensive for new buyers coming into the market. Everybody talks about inflation, right? It's cooling, sure, the headline number, but core inflation remains kind of sticky, particularly in housing, right? Which is most relevant for a lot of our investors, along with services. So I think with that information, there's some key themes to watch. You know, maybe I'll hit the first two here, Andrew, and if you want to take the second two, but you know, monetary policy shift. This is interest rates, right? Most central banks across the world are moving from raising interest rates, which impacts things like borrowing rates, like mortgages, other credit borrowing. As you see central banks raise interest rates, it becomes more expensive. We started to see them ease off that, and actually the US central bank lowered the benchmark interest rate earlier this year, something that might happen again before year end. I'm skeptical. Andrew talked a little bit about inflation dynamics. You know, inflation remains high in the housing sector. Rent prices actually have climbed almost 8% year over year. So if you don't own a home and you're renting, those prices are going up. Healthcare costs this year are up almost 5%. think this really poses a challenge for the Feds and the monetary policy group, their efforts to control inflation and get that back down to 2%, which is their long-term target.
Yeah. And when we look, that's the Fed domestically, but globally, we're seeing really growth moderation. There are specific areas that we see exploding, certain developed markets, even emerging markets that are really exploding against their previously thought projections. So we're monitoring and looking at global growth and where we want to pick our spots geographically. And then we see the trend of value alignment that is really taking shape, not only in our client portfolios and our client conversations, but across the board. And how do we invest dollars while also making sure that the companies we're investing in are doing things that we agree with and having a positive impact on the world? And that's really trickling down on where dollars are being allocated. And honestly, there are certain companies getting punished right now for what would be non-sustainable and non-value aligned practices. So we'll talk about that a little bit more later as well.
For sure. Yeah. We love busy slides here at Zenith. I think this one speaks well to monetary policy and kind of the impact of interest rates and their effect on inflation. We talk a little bit about how interest rates affect bonds, right? Fixed income, and stocks or equities. I do want to call out in this piece, right? Yields tend to have very quick effects on public markets like stocks and bonds. We have to remember that 96% of companies in the United States are private. They are not on publicly traded exchanges. 85% of companies with over $100 million in revenues are also private. Some of the largest companies in the country, in the world, are private companies. Their data and their pricing does not happen as fast as it does on public markets. I think this chart here on the left really shows how quickly treasury yields change, which are, the bond yields of bonds issued by the US government to finance our big deficit that we have in this country. They change frequently. Look at all the squigglies in the line, right? I think this is what we see in public markets. This is what we've seen over the last few years. But in private markets, we've seen a much more steady effect. And I think it speaks to the need for investors to be properly diversified by investing in private markets alongside what we see here in public markets.
Yeah, I agree. I'll also add, we hear a lot about interest rates for those borrowing, but we don't hear a lot about interest rates for those who are earning dollars, specifically our retirement folks. And so there are folks who rising interest rates are a good thing. Getting higher CD, higher cash balances if they've saved well and want a safer allocation. So interest rate rising and that monetary policy, depending on where you are, can really change what you're looking for and whether it's a good or bad thing for you.
Yeah. I mean, I like taking risk, Andrew, but I know you tend to be a safe investor. I know you're upset about these money market rates going down. I mean, what do we think about this? Savings are not as attractive anymore.
It's sad. I'm sad about it. I'm also a borrower, so I'm excited to have lower mortgages and lower lines of credit across the board. But, for the last few cycles, last few quarters, folks being able to get 5 to 6% without having to sweat, made people feel like what it must have been like in the 80s. So I just got a little sneak peek.
There we go. Yeah, we got message in the chat. Thanks for that. We got other sad folks. I think that speaks to actually a question we got in advance. Can you explain why cash and savings accounts become more attractive during periods of rising rates? Andrew, I think you touched on this a little bit, but I'm going to dive maybe a little bit deeper into that.
Absolutely. If we can get 5% rate of return without taking any risk, then other more risk assets have to become more and more attractive. And if we can meet our needs, if folks can live their lives off of the safe assets, then they really just wouldn't put cash into the stock market. So as we see rates go up, a lot of times folk can make the decision to just take the safe money, right? Take the safe bet instead of putting dollars into the stock market or into other risk assets. And as they fall down and bonds and cash become less attractive as a rate of return, we could see people putting more money back into the stock market, even though, as you mentioned, Jason, it is very, very highly valued right now, really expensive stocks.
Yeah. And I think too, what's been hitting on that is really inflation dynamics. You'll see here on screen on the top, we've got inflation since 2000, just what that trailing 12-month inflation number looks like. You can see here the spike that we saw in 2020 to 2022, right? And this is really where we saw the Federal Reserve raise interest rates to try to cool inflation down. Nobody wants inflation at 8%, right? That causes a lot of issues, from pricing power to the ability to construct new projects because the price of materials is all over the place. For those of you driving, I love to drive. Train, not so much. Love to drive. Gas prices were through the roof. Everything really is impacted by inflation. I think it's one of the most important measures that we see in the US economy. But on the bottom, in light of what actual inflation is, what people expect inflation to be in the future and how people expect prices to go forward is a more important driver to the US economy than actual inflation numbers. So these expectations matter. And you can see how inflation spiked in 2022. And you can see this chart's a little from 2020 to 2024. You can see that up, but now expectations are a little stickier. They're remaining high, right? Even though they only got up to 2.4% when actual inflation was 8. So nobody ever really expects inflation. However, we see supply chain issues that are driven by inflation. This year, 65% of public company CEOs reported that supply chain disruptions continue to impact their business. 65%. The government spending is impacted by this. The government's fiscal response to the pandemic and inflation added $4 trillion, $4 trillion of national debt since 2020. Excess government spending continues to fuel inflationary pressures despite efforts to tighten policy. That is regardless of who becomes president, right? This is a legislative action. And then the labor market. US labor shortages persist. The unemployment rate is hovering near 3.8%. Wage inflation's up 5%. It's difficult for companies to control costs without cutting jobs. And we see this dynamic play out in this period of higher inflation and really sticky inflation expectations.
Exactly. That was perfect. We also want to talk about mature markets, mature economies versus emerging markets. And we're actually having this conversation in the middle of a huge economic forum happening in Russia right now with what was formerly the BRICS organization. So we've got Brazil, Russia, India, China. But as of right now, there's actually more emerging markets meeting right now, thinking through economic policy. And we can see right now, as we look through the last 2 years, through 2022 and 2023, emerging economies are really taking and pushing forward some of the global growth that we're seeing here. So even interest rates, as they fall, still are affecting not only our mature markets, but our emerging markets. And it's really interesting to see, as time goes on, as interest rates change and as world banks have some of these tightening or tightening monetary policy, whether or not it will slow down some of these emerging markets, and specifically, the strength of the US dollar and the reserve currency going forward, whether it really takes a toll on some of these other countries as they look to grow and continue to grow.
Well said. And I think that speaks to why some investors have been thinking about integrating other elements of financial analysis into their investment portfolios. I talked a little bit about how streamlined public markets are. We've talked about kind of the key elements of economic analysis in interest rates, inflation, the US dollar. But Andrew, how are values aligned investing in ESG and governance? Like, how is this impacting people's decision making in today's landscape?
It's impacting it a lot. So specifically, we're seeing a shift on who controls the dollars, and it's really important. We're seeing a younger demographic, whether it be millennial or Gen Z or second generation Gen X, receiving the dollars from the baby boomer population, who are answering higher on all of the questions around, I want my dollars to be aligned with my values, not really separating charitable giving and for-profit investing, really seeing it all as one piece. And so as time goes on and the demographic of asset holder gets younger, and our data and our ability to see how companies are performing and affecting globally, whether it be their supply chain or whether it be where they're sourcing different things from, this is a piece that will continue to show up in not only how we create our portfolios, but seeing that there are institutions or organizations who will be negatively impacted from how they score on ESG metrics. And so we're saying ESG, everyone doesn't know. The E in ESG stands for environmental, the S is for social, and the G is for governance. And so we're thinking about climate change. I'm in the Carolinas. We just saw back-to-back hurricane, tornado, hurricane, which is not normal, right? Florida seeing back-to-back hurricanes within a week. And so some of these global environmental pressures are going to show up in policy. And as we see some government crackdown as well, whether it be on the social side with labor movements, whether it be on the governance side with fraud and things like that, we're going to start seeing these factors impact profitability and impact large-scale asset allocators deciding not to invest in certain companies who are bad actors. So as this happens, it's important, it's crucial that your portfolio is built to be sustainable in the long term. And that means removing and scoring some of the companies that may be negatively impacting their workforce, the community around them, and negatively impacting the environment.
Yeah. Well, stay safe over there, Andrew. Natural disasters are scary, so glad everything played out to be all right.
Yeah, meet the bathtub, duck down. We're all
right. And not to call anybody out, but Boeing, for example, just posted a major Q3 loss because their union workers voted on a 35% pay hike. They were on strike, and now the strike's over, and now Boeing's got to pony up, right? And they may have had this issue resolved if they had more equitable pay practices in the past, right? We just had the shareholder proxy with MetLife, Andrew, here, our own clients. We have clients invested in MetLife, which is an global insurance company. There's been an effort from asset management companies across the US. So think companies like Vanguard, BlackRock, big asset management companies who have demanded for racial equity audits at Fortune 500 companies. And, most organizations have voted against. They're saying, oh, the board management team, we don't want a racial equity audit probably because our policies are terrible. And shareholders are requiring this. And we actually just had a security MetLife who said, hey, the board was like, hey, we don't need this. We were able to gather our shareholders together alongside our partners at Ethic and other shareholders and actually push forward that racial equity audit for MetLife when management voted against it. So, people care. And it's not just like, even if you don't care, the people who are managing your money, they likely have other clients who care. And as they go about their own policies and practices, their actions are likely going to be influenced by these factors. So it's changing quickly.
Agree. And that doesn't even talk about monopolistic and anti-monopolistic lawsuits coming down in technology and AI, and how, some of the AI companies looking forward are being pressured from environmental companies to make sure that they're not exacerbating climate change in the way that they mine and process AI thinking tools. So sustainability going forward is very important. It's here to stay.
That you're hitting on a hot button there. AI, everybody loves their NVIDIA. Don't let it come out that their chip making is damaging the environment, Andrew. That would be bad. But thinking about a hot button item, I mean, how can we can't have a third quarter update here in an election year and not talk about it, right? We had a question that may drive our response here. Let me pull up the question that we got in advance. In your opinion, what should investors focus on during an election year to avoid overreacting to political events?
I'm a big fan of the term zoom out. When we zoom out and look at previous election cycles, whether it be, 2008, 16, what we see is that the overall market is steady through the actual cycle. There's a lot of timidity, and you could say that the media drives fear, and fear and anxiety drive the market. Leading up to them, there's a lot of volatility. But once we zoom out and look out this time next year, we're typically seeing a well-performing market, or even sometimes when the market doesn't perform so well, it's not tied to the election. It's usually tied to underlying fundamentals and where we are in the cycle. So my advice would be literally on whatever the sheet you are that tracks it to zoom out and see how these cycles go, and then stay in line with whatever your asset allocation or your goal settings are. But love to hear your thoughts as well.
I think it makes sense. Like I think two things. One, long-term focus, right? Like historical data shows that markets tend to perform well 6 to 12 months after elections, regardless of who wins. In fact, the S&P 500's average is 7.8 return in percent return in the 12 months following U.S. midterm elections as well. So there may not actually be a correlation, but in case there is, make sure you're diversified. Point number two, right?
Yeah.
Diversification is essential. It's difficult to know who's going to win, especially in this one's a tightly contested race, which most of them seem to be, at least in my lifetime. Different sectors may do well depending on what candidate wins. So making sure that you're broadly exposed to many different sectors and markets and areas of the economy and asset types is really the way to approach not being too worried about concentration in case somebody wins. For those of you who own the S&P 500, there's a lot of technology in there. I would consider what would happen, and what type of risk are you taking by owning something like that when we've got these two starkly different candidates? But I think some of that. Oh yeah,
I've got a question for you about that. So being able to be diversified is important. What about for a client who might have an over concentration in a stock? Maybe they are they're employees of NVIDIA, or they're employees of a specific sector, and they can't really diversify out of a specific stock or a specific sector. What are some ideas around how they should, mitigate these choppy waters?
Great question. I mean, the first step that I would take, the more concentrated you are in one particular sector or company on public markets, the more of your other dollars should be out of public markets, invested in alternatives or invested in something else that provides a totally different uncorrelated return stream than what's going on in your kind of public market exposure. The second thing is, I think that most folks who do have concentration have more information than the broader market about that holding that they have. So taking a long-term approach, we always say it, but anything can happen in the short term. The range of potential outcomes that's going to happen with the company in the short term is wide. But as you stretch time out and lengthen time, I think there's a little bit more certainty, and those who have more knowledge, I think you got to be patient. There's a reason that you're concentrated. And if you lack conviction or clarity on that concentrated position, I think you've got to explore solutions to unwind it or diversify outside of the asset type, which I would consider public equities.
Yeah. Okay. Diversify out with all your other assets, non-correlated assets with your sector and the individual equity you're holding.
That's it. And I think looking ahead, there are some things that I think investors should consider. The first, we already talked about long-term focus. That's what we do here at Zenith. We're not focused on the next quarter, right? We pay attention and it informs our long-term perspective, but it's not the KPI that we're looking at. Some things though, bonds looking more attractive. There was actually a Goldman Sachs analyst came out yesterday and said they think the S&P 500 is going to return very nominal returns over the next 10 years, and U.S. Treasury bonds are going to outperform the stock market. Hot take.
Hot take.
I've heard this one before. I've seen this movie before. They never seem right in a take like this. But considering the returns that we've seen, it could be. Bonds definitely look more attractive. Yields are up, prices are down. Let's buy while the prices are down, while yields could potentially go down and prices could go up. Geopolitical risk cause, volatility and uncertainty. I think if you are thinking about, investing in international emerging markets, this is something to consider. We've seen some emerging markets and some international markets really struggle as the US dollar has been strong. And as we've seen global risk intensify, could be an interesting entry point. I think looking at international markets, that volatility that we've seen could create some really attractive prices for investors.
Yeah. I'll also add to that, just before we get the fourth point, a lot of our multinational companies in the US are exposed globally. And so, we saw that with Ukraine, the invasion of Ukraine, it affected US supply chains for a lot of our larger companies at a high level. So even if you're not invested overseas, you are invested overseas if you're holding the S&P 500.
Yeah. Speaking of S&P 500, last point, public markets don't tell the whole story anymore, right? Alternative investments, private markets are getting more democratized and mainstream. I already mentioned some stats around how big the market is compared to public markets. I'm going to go out and say if investors do not own private investments, you are not properly diversified in your portfolio. We can help you think about that here at Zenith. We've got a lot more commentary and thoughts on this point. Obviously not right for everybody, but we want to make sure we continue to pound the table for increased diversification and more certainty in your financial plan or investment policy. So thank you. If anybody has any questions, feel free to throw them in the chat. Here's our barcode. Visit it. Tell us what's up. Give us feedback. Take our survey. Leave us a Google review on our Google Maps page. And we will see you all next time.